This week, we have 4 power-packed webinars lined up for you. First, at 10 a.m., we have Idea Series, Should You Do a Lumpsum in Large Cap? In this webinar, we shall discuss the stability and growth potential in large cap. At 11 a.m., we have 2 webinars, one on quick commerce, the future of retail. In this webinar, we shall explore the business models powering Q-commerce. The other one is exclusive for women, the power of lump sum investing, accelerating your wealth creation. At noon, we have Decoding Myths of Mutual Fund Investing, in which we shall discuss the myths and realities around mutual fund investing. The links are given below in the description. Register now and join us on Saturday.
Welcome to this episode of Talking Straight with Shyam Sekhar. As investors, there is a need to constantly reinvent our strategies and approach to the market. In this video, we'll be asking a series of questions to Mr. Shyam Sekhar and hearing his journey and views on navigating today's market complexities. I'll be asking these questions as a PMS investor, and Shyam will be answering these questions from a fund manager's perspective. Hello, sir. You've worn multiple hats throughout your 35 years of investment journey. You've been a business owner, you've been a mutual fund advisor, and a fund manager. So I'd like to start this session with your stint as an investment advisor. As a registered investment advisor, you work with mutual fund investors for over a decade. I'd like to hear what were your biggest takeaways from working with mutual fund investors and how have they shaped the PMS funds that you manage today?
The one important learning that I have from working as a mutual fund advisor is that investors mostly are not trained to differentiate between past performance and future performance. We may have exceptional past performance in some part of the market, like you had recently in defense, public sector stocks, PSU banks, but the same in the last 6 months have turned deeply negative. So when we bought some of the themes which ran very similar to these, or actually were these themes, PSU was one theme, the investors are always wondering, why are you buying this theme? So investors are so anchored to past performance that they question buying themes which don't have past performance. And when you refuse to buy them like 6 months ago, because the past performance is at its peak and you want to sell and you actually tell them it's the time to sell and you make people sell, a lot of people ask, why can't I buy? I am a long-term investor. The reason is that people don't differentiate between past performance and future performance, don't understand that they could be very divergent, and generally simplify that past performance will also run in the future. I think this is the core of what is missing in the mutual fund investing of an individual investor or any investor actually. This is what I learned was the clear distinctive drawback of mutual fund investing, and as an advisor, however hard we try to bridge that drawback and correct it, the investor's habit and investor's inclination is to go back to past performance. So making investors participate in that kind of an approach was extremely stressful. A coach can create a good sportsman or student only if the sportsman listens to the coach. If the sportsman refuses to listen to the coach and says that he will play his own game and just keep the coach for namesake, that is not a motivating factor for a coach. And that is how I felt is the best summary of my experience as an investment advisor.
Okay. So you've known to manage risks very well in portfolios. You've always been very religious with managing risks in a portfolio. So if you take a market like today, there's general perception that more risk means more returns. This is the reason that we saw a frenzy in the small cap space as well, based on the narrative that more risk is more returns. So how do you measure risk and returns?
See, in my view, more risk does not translate into more returns. excessive speed in driving doesn't take you faster to the destination. It only increases the risk of an accident. Similarly, excessive risks rarely give great returns. Most of the time they lead to investment accidents. In my opinion, you should take risk within a certain band, never go out of that band. And even within that band, you should raise the risk only when the returns look more favorable. That is, when the valuations are more in your favor. At that time, you take enhanced risk. Don't take enhanced risk when the valuation is at the peak end of the valuation spectrum. When it's near the top, that's not the time to take high risk. So, risk taking itself has to be calibrated. There is no one approach, but there are some things that you clearly should not do. And the most important thing is to keep your risk within a certain band, to keep it in check. Raise your risks only when the valuations are extremely in your favor. And most of the time, stick to the medium risk zone and don't go either to the low risk zone or too much to the high risk zone. Stay in the middle. Maybe move a little towards lesser risk when the valuations are very high. And from that place, when valuations start falling, move towards the median risk and then take a little more risk. So it's a very calibrated and measured approach to risk which I advocate as the right thing for every investor to do.
Okay. While we're on the topic of risk, so if you look product specific, investors often wonder, is a PMS riskier than mutual funds? So do you think there is risk management that is done better in a mutual fund or in a PMS?
Rarely in a mutual fund scheme, you find it's all about the fund manager. The product is supreme. But yes, we give a lot of credence to the fund manager. We give a lot of importance to the fund manager. But we don't say that this product is all about only this person. Even if that fund manager goes, you continue to invest in that product. For example, you have seen changes in fund managers and still the next person has done equally well in several products. But in a PMS, there is a tendency to make the product all about the fund manager, his personality, his past achievement, what he believes is the right thing to do in the present, and what he thinks is the roadmap for the future. It becomes very narcissistic, personality centric. So in that sense, a mutual fund can be less personality centric than a PMS. But having said that, a PMS is only an enabling license to operate as a fund manager. There is definitely no need for a fund manager to amplify his personality so much in the public domain. He can still remain low profile and create products that suit the personality of the investor. When the product is created using a mutual fund, when a product is created using a PMS license, around the personality of the investor and what suits the investor, then it becomes superior to a mutual fund product. However, if the product is all about the fund manager and what he thinks is correct and very narcissistic, at that point, it starts being meaningful to the investor because his connect is not there. The product is fully connected to the fund manager and loses its connect to the investor. So, how you use a PMS license, how you position the products that you create, how you ensure they remain investor centric is the critical success factor for a PMS. It is a very, very important thing. In fact, it is the most important thing. Returns, who is the fund manager, how returns came, all that comes after that. But the product and its investor or customer centricity is the supreme differentiator and the main thing that makes a PMS better than a mutual fund.
Okay. So let's take, I'm a market participant and I've been investing in mutual funds for a while. How should I decide when to add a PMS or what portion should I allocate towards my PMS? How should a mutual fund investor look at adding PMS to their portfolio?
Well, typically, a mutual fund investor has at least 5 or 6 schemes. In these 1 or 2 schemes are cyclical schemes. They become extremely successful. For example, if you are a small cap investor and you have been investing from, let us say, 2014 and you never sold it. Today it's at a peak valuation. Same with mid cap. You have seen similar thematic successes in multiple areas. So people do own these things. At a time like this, they could probably sell those things because it has become too good to be true. And then decide if they need a PMS product. They do their homework to study which PMS product is best suited for their goals, their aspirations, their personality and their financial profile. And once you identify that product, maybe you can move some of the monies which you have booked in mutual funds as profits and holding as liquidity into a PMS. And that PMS should also deploy that money gradually as the market falls and not in one day. So you have to make sure that the philosophy of the PMS is to be very conservative, correct and calculative.
When markets are at all-time highs, investors are usually hesitant to invest money. Should an investor wait on cash, or is staying invested the best strategy?
See, assume you are an existing investor in a PMS. We manage several strategies. You are an existing investor in one of them. The question that is important to you at this point is there scope to invest in some idea, fresh or existing, in this strategy, in this product? If your fund manager or your relationship guy says, yes, we need that money, then you can invest to the extent that the portfolio can take. And you keep money separately, let's say in a liquid or arbitrage fund, which can be taken anytime and put into the portfolio if there is a correction. The critical thing is the market corrects 1% on a given day, mid cap corrects 2% or 2.5%, and small cap corrects 4%. So if you have a 5% fall at the Nifty level, chances are you could have a 10% fall at the mid cap level and a 20% fall at the small cap level. So in the companies that you want to invest or we want to invest as your manager, the opportunity will suddenly come up where it is very attractively valued because somebody sold it all the way down very aggressively. On that day, liquidity is required.
Right.
Without the liquidity available on that day, you will not be able to quickly buy what you want to buy. Because when such corrections happen, a lot of people are waiting for such opportunities. You are not the only person. So the smarter people are those who actually deploy, complete and move on. Whereas the overthinking guy, who is not sure whether he should keep money idle, where he should keep it, how much return it should create for him when it's idle, what kind of risk is comfortable with at that point in time. He doesn't think of all that, he's just chasing returns. He will not have the liquidity. So when the market falls, that investor is not able to give us the money. So he doesn't participate at all. The important thing is to participate. That is the most critical thing. So the liquidity should be channeled correctly at every point in time where opportunity looks best, strongest.
Over the last 4.5 years, we've seen the markets do a one-way show. We've only seen the markets move up with minor dips in between. Given this, should an investor consider taking out money?
It entirely depends on where your money is invested. People apply one question to all situations. It doesn't work like that. Let us assume that you are invested in a small cap fund. I think you should take out the money because the entire small cap index and stocks outside of it, the entire small cap investment universe seems to be overvalued. Probably 5% of the stocks are undervalued, and those are not really easily investable. There won't be volumes in them, some of them like that. So in the market-wide overvaluation is prevalent, at that point you must take your money to safety. It is a necessity. So in my opinion, a small cap universe is probably overvalued by at least 30 to 40%. And when it falls, it can fall more than what the overvaluation is. It can go to an irrational extreme. However, if you are invested in a large cap product, which is more economy specific and centric, pure large cap product, then the valuation of that space overall itself is only 10% above the historic median, right?
Yeah.
But if your fund manager has invested diligently to keep the valuation within his portfolio in check, then you don't have to sell that investment. So it's a portfolio centric decision and a theme centric decision. There are two levels at which the decision has to be taken. Is the entire theme overvalued? That is one level. Is my portfolio overvalued relative to the theme? Is my fund manager running at a higher risk than even the theme overall? These two questions will give you a very clear decision whether to sell or not. You don't take the sell decision based on what the Nifty is. You take the sell decision based on where your theme is and where your specific portfolio managed by a specific fund manager is. Whether it is PMS or it is MFD, this principle will apply. People look at Nifty and say that they want to sell. That is a wrong approach. I will give you an example. In 2008, peak of the bull run, Nifty was doing great, but I felt that it is worth investing in two spaces. One is FMCG and other is pharma. Now, these were almost the first funds into which I thought clients were asked to invest. Now, at that time, everybody was into infra. So, if you take a market-wide decision, people will say index is very high, sell everything. But actually, you should have sold only infra. You should have sold the top 200 fund that time because it had a heavy overdose of overvalued stocks. You should not have sold pharma and FMCG at that time. So, the product level, team level decision has to be taken and not a market level decision. Selling is a very nuanced thing. You cannot make a nuanced thing very generic and then make decisions which are generic. If you do that, you are not doing justice to decision making. You are not doing justice to your portfolio. This is how I think people should look at it in every bull market. Because there are pockets of overvaluation, there are pockets of undervaluation. If you are invested in pockets of overvaluation, you need to sell. If you are invested in pockets of undervaluation or pockets of moderate valuation, you need not sell. You have to know where you are invested.
Okay, look, there is a narrative of long-term investing. So there's a narrative that says if I invest for 10 years and 15 years, there is no need for me to take out money, be it an overvalued space or an undervalued space. It goes through this cycle, but I am invested for 15 years. Why should I take money? So for an investor that's asking this question.
Particularly in mutual fund, people are saying this. It's a very, very wrong approach. Let me explain. Now, people have poured money in the last 1 year into small cap funds. Public has poured money. You are a disciplined investor who has been pouring money into it for the last 10 years, not in last 1 year. Now, 2 years later, suppose this space doesn't perform well or it shows a 20% loss like defense is showing today within 6 months. What people will do is, those who poured this money will want to take out the money, right? So what will the fund manager do? He will not have the liquidity. So he will sell the better stocks which are liquid to meet the redemption of all these guys who are fair weather investors. And you are sitting there. Now when he sells better stock at a lower price, there is a NAV hit. Who is going to take this hit? The disciplined investor is going to pay the price of the indisciplined investor's actions. Now it is such a commonsensical thing that you should sell before the indisciplined investor. If he says, no, I am a great disciplined investor and I will sit with a bunch of indisciplined characters in a product and I am ready to be affected by their indiscipline, how does it make you an intelligent investor? I can't see the logic of how you will be an intelligent investor in such a hot space by staying invested. You have a duty to protect yourself from the irrational, wrong behavior of those who are co-invested with you in a mutual fund portfolio. It is your responsibility. It is not the fund manager's responsibility. He cannot do it.
So you've been a fund manager who has always been very disciplined about valuations. This is the same way that you run your PMS funds. While there is a risk of investing all the money in just one go, there is also a risk of sitting on cash, a risk of underperformance. So how do you balance the risk of sitting on cash and grabbing opportunities?
And neither of these things affect me, frankly. The reason is simple. At every point in time, you will find pockets of undervaluation. Suppose I did not invest aggressively before the market bumped up in a particular point of time or in a particular context, then I will still get opportunity somewhere else after a few weeks or a few months. All I need to do is be self-aware that I made a mistake sitting out there, but now let me be more watchful. You will find something next. You will find a better opportunity actually. So it's like if you miss the bus, you take the next best bus. You don't become glum and deeply depressed because you missed one rally or you underperformed for 5 or 6 months. Market gives you a lot of time to catch up. This is a classic hare and tortoise race. But remember that you have missed something. Learn your lessons from such episodes. That is how I will see a case where if I take a cash call and I am caught out. But generally, I don't take such calls which are, kind of trying to tell others that I am very different from the market. There's nobody like me. I don't want to make such drastic statements because this is a boring pursuit of managing a portfolio of decent stocks, right? And I should just do whatever it takes at the stock level and the portfolio level. And if I am able to sell stocks when they become too overvalued, and if I don't find opportunity to buy something, I just keep it as cash. I don't decide that I am going to raise so much cash and then do some crazy selling. But if there is merit in selling, I sell and I hold the cash and slowly my cash level keeps going up. I am self-aware that the cash level is going up. I am also looking out for new opportunities, but I am under no compulsion to deploy the money because there is cash. I keep working on the new opportunities, and as some opportunities come under my radar, we do the research in a few weeks, complete the research, then review the research, and then get conviction that some stocks are worthy of being bought. Then we gradually deploy the capital in those stocks. So it's a kind of a gradual churn. It's like a giant wheel that moves in one of those cities. You've seen the London giant wheel or the Singapore giant wheel. It keeps moving slowly, right? Similarly, the investment process also keeps moving slowly. It doesn't do drastic things because there is liquidity. And it doesn't do drastic things simply to create liquidity. It acts on merit. By doing this, you are likely to outperform whatever you are comparing with. The first point. The comparisons don't become the primary drivers of your behavior as a manager. You are not always comparing and trying to catch up with something. You are aware of performance, but you are not completely dominated and driven by performance. So the investment merits are the center of your focus, and you keep on doing things around those investment merits. Performance will follow. If there is liquidity, so be it. Wait for investment merits that you really like and you are convinced about. Do not deploy if you don't have such conviction. Deploy only when you have such conviction. If you follow a process like this, I don't think you have to worry about anything.
We have more questions and more insights to hear from Shyam. Stay tuned.